Well, thank you everyone for making time to come into the final webinar for 2023 with JCB, Finding Stability in Uncertain Times. For those of you that don't know me, I'm James Biggins. Matt, if we can flick to the disclaimer slide, please. Just read that and we will send you a copy of this after the presentation. Today, I'm fortunately joined by Charlie Jamieson, CEO of Jamieson Coote Bonds. So thanks for joining, Charlie. This webinar is going to run till 10:45, so it will be punchy. We will be flying through a lot of macro data and thoughts from the JCB desk. But Charlie, what a year. 2023 has been an extraordinary year for the bond market. I don't think I've seen bonds in vogue or on the front page of papers in my career. So I can only imagine what it's been like for you sitting on the desk watching it from a day-to-day basis. So I just wanted to get your thoughts to begin with on what are the major driving factors in yields and, how you're seeing it playing out.
If we take a step back, obviously, the rise of interest rates from central bank policy that's had to deal with inflationary issues. In 2022, that was just in fast forward the world over. Everybody moved quickly, much faster than they'd previously articulated, and it was universal ex-Japan, basically. This year, obviously, we've had a continuation of that, probably further than a lot of us, if we're honest, would have thought was possible in that time frame. And if we look at this slide here, you can just see the speed of these moves is simply unprecedented. And it really matters in that the starting point really will matter as we look forward. My father always tells me to stop complaining about my mortgage, and I kind of remind him that, yes, you had a teens interest rate mortgage, which nobody would want, but the rate of change was slight. So if it went from 12% to 15%, if you needed $120 a month, then you only needed $150. What we're asking folks to do here is to go from $200 a month, let's say at 2%, to $600 or $700 a month. So that function is simply extraordinary and is still going to wash through the economy, particularly here in Australia, into next year. But it's not going to wash through all economies equally. So I think, we all know this kind of stuff. Before we get into that, clearly the other thing that's been very impactful of late has been concern around US deficit spending. We're at the end of the cycle, spending like a drunken sailor. It doesn't look sustainable, and certainly if the Treasury was to issue more coupon bonds, the bond market got really worried about that. It was a really big deal until it hasn't been a big deal of late. So we had a big sell-off in October in and around that. And whilst Treasuries are on the move, other fixed income markets around the world have been following in sympathy. Australia has really moved, 1 for 1, even if a little bit more in that, obviously compounded by the fact that the RBA really got in their emergency rate hike in November. But if we do come forward a slide, Matt, I think it's important to look at the way that this is all going to impact economies. And clearly, we hear a lot about, yes, Australia hasn't done enough. New Zealand have got to 5.5. The UK are in the 5s. The US is in the 5s. Even Europe is in the 4s, which seemed extraordinary only a few years ago. Australia in the 4s just simply isn't enough. Well, actually, it's a huge amount, and it's still to come into the economy. Now, a lot of things get masked in the Australian economy by bringing in new players every year, with 500,000 people arriving in net migration. We're going to have a bigger economy. The pie grows. And so when we look at things like GDP or retail sales or consumption, we need to think, it's great that they're still positive in an absolute sense, but relatively, and if we go down to kind of more real data, we're not doing as well as we think. Even retail sales in the US last night, it's a big miss if you think about it inflation adjusted. It's been 12 months of consecutive falls. So whilst it's a headline number at a positive level, clearly with still a reasonable inflation pulse, we're not keeping up with inflation. So the economy is just losing a bit of momentum. And I do think that's important. So we've got here, I guess, bonds have led the charge. This year, obviously, they've still had a lot of negativity around them. And it's really been that performance of duration, which is, gets a lot of media attention and it's poor performance, to be honest. We'll have a look later on about why that's actually a minor part of the bond story. It's everything when it's the major issue. And if you're a speculator, that's absolutely the major issue. But if you're an investor, what's happened actually brings a wonderful series of opportunities onto the table in our space, in sovereign bonds, clearly in corporate credit, in everything, fixed income, to be honest. And certainly will draw capital from other parts of the investment complex that were very well sponsored previously in a, there is no alternative zero interest rate world. So we still think that those changes, are yet to really come through the markets, and probably a reasonable time to just talk about asset quality and why we do what we do, maybe refresh for a few folks.
Well, I think that's really important when you talk about, you've got speculators and investors. And when we talk about investors, that's probably our client base and potential clients. And it'd be great to unpack asset quality in terms of liquidity as well, and just share how we think, high performing or high sovereign bonds are actually going to be worthwhile looking at in a total portfolio context.
Yeah, look, we've got a couple of slides here that we'll share with you. Look, we run the most boring part of your investment portfolio. It's kind of the piece that you're supposed to start with. When we all did our economics degrees, it was the risk-free rate of return. Of course, it is risk-free if you hold it to maturity. And sadly, the governments don't die sometimes. Sometimes I wish they would, but they don't. Whereas corporates in Australia, we're very lucky. We really don't run into that very often. But historically, when we have credit cycles, corporates can die. We know that corporate credit can be quite risk-like when things get into stress. And so this is an extraordinary period. Heaven help us, we don't see this again. But we are much more vulnerable as a financial ecosystem, with interest rates up in the fives, with the global cost of capital significantly raised. And of course, the long and variable lag means that nothing happens and then everything happens. And so when, that rate of change becomes a bit logarithmic as it decays, there are some early warning signs which are obvious to everyone that's watching. But when it'll accelerate and get that real catalyst kicker, is anyone's guess. So again, in the short term, markets are hard to read. But in the medium to long term, I think, we've got more certainty about where we'll go. We're not propped up in the way that we were, particularly coming out of this period where we had epic fiscal policy, epic monetary policy, epic liquidity policy. And we know what happened thereafter. Everything that was red became really black. And of course, we had a real big slingshot or a V-shaped performance in assets that had suffered going into COVID. Because of inflation just ebbing away and those embers still burning just a bit too brightly, it's not easy for central bankers to come in and cut interest rates and provide huge amounts of liquidity when we have some of these issues, which we know we will face at some time.
And I think it's just, sorry to interrupt, I think it's important for clients to understand that, these assets can perform in very distressed markets. And what you can see is, an ability for us to provide protection in terms of upside, in terms of capital, but also when you want your money back, it's available there for you to actually collect. Where in other asset classes, we did see that really large gap of bid and ask spreads and people not being able to actually take that capital and deploy it elsewhere.
Sure. I mean, they were extraordinary markets, but, we've had these episodes. We had them in COVID. We had them at the end of 2018. We had them at the start of 18. We had them in the middle of 2016. So periodically we are having these issues. And maybe if we have them again, they're not going to be as easy to solve this time because that inflation impulse doesn't make it easy to stimulate hard from underneath. You will fan the embers of inflation, and that causes another big problem. So I guess, hand on heart, we can say to folks, there are a few years in longer cycles where sovereign assets really make sense, or certainly having a larger allocation. We're never arguing for 100 cents in the fixed income dollar. That's absurd. But certainly where people had none, I think they should have a little bit, and potentially maybe even a bit more. And then there is that cycle dynamic. And I guess that's one of the reasons that we wanted to disaggregate sovereign risk from corporate credit, so that asset allocators have got more precision through the cycle. We think it's a very credible thing to hold, certainly with interest rates restored. I mean, if you can buy a 5% yielding bond, a 30-year bond, and reinvest every coupon at 5% throughout the 30-year period, you have a total return of 429%. That's the kind of thing you can stick in a kid's education fund. I mean, let alone 6 or 7 or, some of these other numbers that get bandied around. I think anyone that watches the bond market and watches their equity portfolio realises that there are limitations to how far we can pull on the rubber band of interest rates before things get hard everywhere else. And so, for everybody that wants to tell me that rates have to go to 6%, well, look, they can, of course they can, but everything else is going to get taken with it. And so there are limitations to how much of that will occur without having the negative feedback loops that clearly occur, and they become very deflationary if we burst asset bubbles. And in of itself, that becomes self-correcting. And so that's why you'll see later on when we show you, long-run performance, that we do have this self-correcting nature in the bond market. But this slide's an interesting one. Everybody knows this again. When you raise the international cost of capital, look, it could be a financial market thing. It can be triggered by a natural disaster. There can be a
geopolitics.
Yeah, we're on vulnerable ground, now, because funding rates are high. The ability for people to roll large loan obligations forward is becoming more complex. It's not necessarily about, I don't like the 8 or 9% interest rate that I'm being offered when I was paying 4 as a corporate. It might be that we just simply refuse to provide you the ability to roll forward. We'd like to be repaid as well. And that's a kind of bottleneck problem like we've seen in the Euro sovereign crisis, where, there's just a bunch of people that can't refi at all. Now, thankfully, that's a little ways down the line, and hopefully we can build a bridge to maybe getting some rate cuts next year. US inflation's at 3.2% year on year as of day before yesterday's data. We've got essentially a 5.4% Federal Reserve funds rate. That's pretty restrictive. So the chance to actually give something back and still be restrictive if inflation does moderate in, say, a 3 to 3.5 or wherever we might expect it more long run, well, then the Fed funds rate can come down, and that can certainly help assets make it through that journey, because otherwise they're going to run into the brick wall of very restrictive interest rates, real positive yields, and that's just not good for things longer term. If it's a bit of a one-touch and a tumble turn in the swimming pool, then we can get away with it. But, the longer that we need to stay at much higher interest rate settings, the more problematic that becomes through time, particularly as we go through refinancings into the back part of 24 and 25, when the maturity walls become much more pronounced.
Yeah. And then I think the next slide kind of explains how we're positioned, or 10-year yields, and, trying to get your view on where we might see, activity levels for us to get conviction and taking on, getting really long duration. It'd be great to kind of get your thoughts on that as well.
Yeah, look, as an active manager, we've had a couple of goes at buying the market and owning duration with some success and then moving out again. But clearly in the short run, this evolution of the US fiscal story and the concern around that is meaning that we're adding what we call term premium to the market. And we've seen yields get up to that kind of magic 5% number. It was starting to take everything else with it at that time. And thankfully, the US Treasury have changed the funding mix a little bit, and it's kind of a story that's gone away for a little while. I think until we get weaker economic data, then the problem with the bond market is there is no problem. And so, very much like 2007, 2023, after we've had a period of incredible change in interest rate policy in the short end, prior to the GFC, obviously we had Fed funds go from 1% in 2004 up to 5.25% in 2006. And then nothing happened for a while. We had a few, little risk episodes. Bear Stearns went down. A few funds were gated. And everybody got very bearish on risk a little bit too early. And we had this, wonderful rally in equity markets in the back part of 07. And then, of course, and I remember very well people saying, subprime's not an issue. We know about subprime. It can't be the thing. It's always the unknown that comes to get you. Well, of course, it was absolutely the thing in 2008. Things started to move really quick. So, do we expect that we'll have issues into the future? Yeah, I think we will. They're not obvious right now necessarily. We've had episodes, SVB at the start of the year, some of these issues. Growth is slowing the world over. Europe is essentially teetering on recession. The UK is teetering. China's pretty dire. We're going along okay with a bit more momentum. The US is going great. They're hard to slow down. They've got really long-dated mortgage product. If you've got a job, as US folk workers certainly do, and you've got spending power, then who cares if the Federal Reserve raises rates? You've already locked up your 30-year money at 3%. So generally in the US, the slowdown comes via the corporate bond market, and they've done a really good job of terming out their debt, which delays this a little bit. Whereas in an economy like Australia, we have a much higher transmission mechanism, we call it. The variability of the loans means that the immediacy of RBA rate hikes comes to fruition much faster. So with regard to getting long duration, and just going back to that slide, Matt, look, we really want to own. If you said to me you can't change your portfolio again, medium to long term, I definitely own duration. No problems there. But it has been still quite violent in the short run. Realised volatility in the bond market remains. We're getting much more volatility in inflation data, as much as we're going through a down cycle at the moment. So we've got to 9% in US inflation, come all the way back to 3. We got up to 3.7. Now we're back at 3.2. It's going to stay bouncy for a while. We're going to have more amplitude in that, which means that we're going to go through periods where it feels like we need to do more with interest rate policy, and periods like yesterday where we're priced in, 75, 100 basis points of rate cuts, as I articulated earlier. If inflation's really at 3.2, then to be at 5.4 in Fed funds looks pretty nasty. You can probably let the reins out a little bit. So I think, our advice to folks that are allocating infrequently is just build ladders into duration. I can't give you the exact level where you're perfectly safe. I don't think any equity manager can tell you that journey in the equity market. There's no bond manager that can do that either. Other than to say that these are extraordinary levels over the course of time. We don't believe if interest rates stay at 5% through time, then the world looks particularly healthy. And so to have government guaranteed, cash flows at 5% that compound nicely, that give you liquidity optionality, that looks really appealing. Obviously, those levels, they're higher than returns on cash. But could we get to higher yields? Yeah, of course we could. But can we stay there? No, probably not, because it starts to take everything else with it. And certainly, as that long and variable lag effect of monetary policy continues to come into the economies, it becomes a bit more problematic. So the shot clock to that moment is definitely falling. And so, we're just needing to see that data really turn over, and then we'll have much more conviction to, get long for that more medium-term kind of trade.
Yeah, excellent. Okay. And then just for everyone, if you could submit questions, we've got a few coming through, but we'd love to hear from you. So please do that in the box below. And if you could flip to the next couple of slides, would be great. So what here we wanted to explore, Charlie, was, how strategically, you've kind of given us some ideas on the US side, but maybe just digging into that a little bit deeper around how we're positioned for this part of the market cycle and where you feel that we are. And I think, it's quite extraordinary. JCB celebrated 10 years this year, and it's the highest yields that JCB have seen in the 10-year history. So that's kind of saying something, I think, for the opportunity for clients as well.
Yeah, look, this is a great chart because, as I said earlier, duration's a side story. So if we go back to 2010, 52.5% return in bonds, including the worst bear market in history that you can see in 21, 22. 23 is actually positive now as a result of the last little while, but when we cut this slide, it wasn't. And you can see that in and of that, the duration effect makes up 4.3% of the 52%, or it's 8% of the total story. The story is all about carry, i.e. what is the prevailing yield on the fund in the bond market, and then the roll. Now, the roll gets a bit technical, but basically if you own a 5% bond that's a 10-year bond and it becomes a 4% bond as a 9-year bond, it goes through a capital appreciation as it rolls down time. So if you've got a positively sloped interest rate curve, that's a really good thing. But they're the major drivers. So for investors, again, we've never seen yields like this, and so that's why it is exciting. Obviously, in this type of product, it is very liquid. It did a great job. We had enormous redemptions in our funds through the COVID period, and people moved on to buy deeply discounted equities and had that optionality very quickly. And we think that's something people need to give consideration to. It's one of the reasons why this is certainly an appealing product. But in and of itself, it's highly investable again with the restoration of yield. And so the index is now up a couple of percent. As I said, it's still volatile in the short run. So we're very happy to talk to you about opportunities in the short term where you might want to come in, or just build an allocation for the medium term. You are getting well paid for it. Obviously, the roll and carry is pretty powerful. And so that's an important concept that we need to consider. If we come forward again, clearly in our world, we run very high quality liquid assets. As I said, it's supposed to be boring by design. And of course, it's more boring most of the time until other things get themselves in trouble. There is nothing obvious that's in trouble. There's a few pockets that are hard. Commercial real estate's an obvious one, these types of things. Construction industry is clearly having issues at the moment. But clearly we want to have a bias to overweight duration at some stage. when central bankers get comfort that inflation has been put back in the bottle to a degree that they can do a little bit more, clearly we would expect duration to do very well. So we like adding. We're certainly trying to come from the long side, notwithstanding Biden's spending plans making that difficult at times. And we're still, subject to some, short-run volatility, which is a bit spicy at times. I don't think, in totality, it's got the ability to continue to move in the way that it has. We've already had massive readjustments. And when we look at the last slide, yes, we've had a period of underperformance through October, but it becomes self-correcting fairly quickly thereafter. So as I said, I think in that slide, down 1.6 in October, we're now up to, as of yesterday's close. I know we've had a long-run discussion about will bonds outperform equities this year. Coming down to the wire, isn't it? And obviously, with equity markets, they can move quickly in the last few days. Do we get the Santa Claus rally? Do we not? It's going to be a bit of a line baller. But clearly, when we look at big matrices of asset class performance, bonds had a shocking year last year, and I think they were 5 out of 10. Now, clearly, there were a lot of things that were worse with much more volatility, obviously. But they're supposed to not draw down in the way that they did. It is very self-correcting though. So thankfully most people that are invested with us are very underweight and have now been building up those durations. They're cautious just because this volatility is still hard to read for everybody in the market. But I don't think that people should lose sight of the medium to long-term goals. We are at levels that we haven't seen for a long time. If we continue to sell off, and we'll touch on that a little bit later, the go-forwards don't look that scary once you get this much income underneath the product, that escalator that, we talked to of carry and roll. I'll just get you to come forward. Thank you, Matt. Just some things that we're watching. Clearly, credit delinquencies is a really obvious one. Just, the general health of consumption in the economies. This is a bit of a nuanced one, but mortgage-backed security spreads are now out to essentially GFC wides, which is a bit scary because you can see the relationship versus corporate credit is pretty tight. Now, we know that corporate credit spreads have done really well. Corporates have got pricing power. They've generally been going okay, but this is not a sustainable relationship. We either need to see those mortgage-backed spreads come down and heal a little bit, or otherwise credit, I fear, might rise to meet them. As I said, that comes when the economies start to weaken a little bit, when we look forward to, their own refinancing needs. Obviously, the US government's in the crosshairs for their refinancing needs, or certainly has been over the course of this year. It's not a credit story, but it does become a credit story into the back part of next year and 2025. We know when credit unwinds in this way, it does become quite pro-cyclical. And the reason for that is that as an over-the-counter market, once you get slippage, investment banks who provide the liquidity tend to stand back. I can tell you that because having managed those businesses in a prior life, the risk managers come downstairs and say, don't take on any more credit, by the way, lose some as well, at a time when the market's liquidity and function is somewhat impaired. So that is just something to think through. I don't think it's a tomorrow story, but into the end of the year, that's always something to think through. When that happens, how that happens, I don't know exactly, but coming from a pretty tight and full valuation level, the repricing of that obviously can pick up a little speed. So it's worth thinking through.
Okay, great. And then we're moving on to, I guess, our outlook, which we've touched on throughout the presentation. But I think the next slide, Matt, is really interesting from an investor's point of view that, this is the worst bond market that we've seen pretty much ever from the pundits that I hear. But I think what everyone's talking about on LinkedIn, from what I've seen, is the bond maths and how it is a self-healing product over time. And I think that's where the opportunity sits. But just talking through this slide, Charlie, it might just give people a bit of comfort that why looking at, high-grade bonds is actually a smart thing to be doing.
Sure. So as we said earlier, they are self-correcting through time. The criticism to this chart is that it's been broadly a bull market the whole way through because we've come down from very high interest rates to much lower rates. Happy to have that conversation if you think rates need to go back to 10% and they're going to stay there. You need to buy a lot of gold and get a very good four-wheel drive and a shotgun because the world doesn't work out anymore as you know it. But clearly, there's been an incredible clean out here. as we've seen from the other periods of underperformance, what happens next is the economy slows down, policy support comes in, and the product tends to do very well. Now, this is great for equity investors. Anyone that is needing to hang on to more lower rate environment that makes net present values higher and gives certainty over the cash flows. The danger, of course, here is that we probably just can't cut to the same degree that we have previously. If there's a problem, I don't think we're going to negative interest rates and QE again because inflation will go to the moon. So, we might temper our expectations for a 20% return year. But if we come forward a slide again, Matt, we'll just have a look at some of the maths as to what might occur. Now, these were cut at the end of last month. Obviously, 10-year bond yields have rallied a reasonable amount since then. On this slide, I can't see. We're missing a bit of... there we go. Look at that. Magic. But so assuming that we started at 493, we're not there anymore on 10-year yields. This is a model that just projects the index return. And the only assumption that we make in this, doing the bond maths, is that if we move to the left and yields are going higher, then we've got an inflation problem and the central bank keep raising rates because they've got inflation credibility, as they have done so far. If we move to the right, they might be able to give something back because inflation's not a problem anymore. And so, in those two instances, we flatten the curve or we steepen the curve, right? So they're the only assumptions. If you want us to run different assumptions for you, it's pretty easy to model. So please ask the question. We're very happy to do the work for you. If nothing happens, and I can't forecast the domestic fund returns because that's illegal, but I can tell you that we monitor this and follow this index pretty closely, and we certainly exist to try and outperform it over time. If nothing happens, which of course that is I can guarantee you 100% that something will happen. But if nothing happens, from the end of October, if you bought bonds and held them for 12 months, you will make a 5.1% total return through roll and carry and some of these things. Very healthy indeed, higher than cash, happy with that. Clearly, if we push to the left, you could have been allocated elsewhere, fully appreciate that. But I dare say that bonds are very investable on an asset relative basis, because if we go to 6% 10-year yields, which is really the scenario one, I dare say that other assets are doing a lot worse than down 0.6. In that environment, you probably want it to be 100% in US dollar cash. Can't really live like that forever, so we do need to make our portfolios work hard through time. Conversely, if we rally back to 4%, then there's more than a 10% expected return. Now, if we have a big enough problem, we'll go a lot further than 4%. I think everybody's pretty attuned to the fact that momentum funds and commodity trading account funds, CTA type funds, have pushed the bond market really hard. A lot of the story has evolved to meet that pricing, and so they moved ahead of time. They are incredibly short the market, which obviously is a dangerous position when we get to the more vulnerable phase of the ecosystem. If they ever turn around and decide to go long, watch out. I mean, we can really rip back pretty hard. As we've seen in the last little while, I mean, we touched 5% and bang, US 10s are at 440 last night. So they are, a bit violent. And certainly when those positions get squeezed, they can squeeze pretty hard. All of a sudden, if the story deteriorates underneath all of that, the squeeze will be quite pronounced. And then there'll certainly be some position cleansing that needs to occur. So again, I can't tell you exactly when and how that will work. It will happen at some stage. I don't know what starting point it will happen from. But certainly, one of the reasons we like building these laddered exposures is it's a regret minimisation strategy. You get a bit on. If it moves to higher levels, you can add more, and that gives you a good total return average. If it slingshots back the other way, you're glad you got some on, and you didn't get as much as you would have liked, but you got something. So I think that's probably the smartest way to go about managing this volatility. Certainly, we're seeing most of the investors that we talk to acknowledging they want to add more, but they're just cautious on exactly how to go about that. Obviously, the volatility gives a rise to some uncertainty. They don't feel like the momentum is completely finished yet. And yet here we are after getting a kicking all year and, up a couple of percent. It's not wonderful, but it's not terrible either. 2022 was terrible. But, here we are we're breaking that momentum. And so once that momentum velocity starts to drop, that's when you start to see those momentum funds starting to think, not getting anywhere here. I'm still sitting at risk. Maybe we need to cover some, go the other way. So, as I said, I don't know when that will happen. I do know at some stage something will go wrong. It always does, sadly. And we are in a much more vulnerable situation. We're all standing on the trapdoor. We don't really, maybe some folks don't know it yet, but with 5.5% funding rates in many developed markets, that's a hell of a change from what we've experienced even back to pre-COVID markets. I mean, the economies were pretty anemic leading into COVID. Obviously, they got this enormous shot in the arm via a lot of fiscal transfer and those types of things. But that, feel-good factor and that revenge spend is probably coming to an end. We know that US consumers have essentially burnt through all of that. In Australia, similarly. So we must expect that the economies do moderate, and at what rate and how quickly that comes together is a 2024 story.
Awesome. Well, I think this chart just really demonstrates there's not much downside to owning bonds at the moment. So that's an exciting place to be. Now, we've got Q&A. Some questions have come through. And I think what you were describing around how you were laddering in positions and how clients could ladder in, this filters into that. But Jerome's asked, with the volatility in rates, how are you actively trading the portfolio and how does duration position changed in recent times? So maybe if we could just explore on that a little bit more, Charlie, that'd be great.
Yeah, so obviously there is still this volatility. We sold a little bit of duration risk yesterday, which has pulled back a little bit overnight. So that's worked well. We're very conscious, I guess, of in the shorter run, what we need to deal with as a marketplace. So we spend a lot of time thinking about government supply calendars. That's a known event. We spend a lot of time thinking about index changes and what the passive community need to do. So we're tinkering around with duration. We have been overweight at times. Clearly that's been problematic. And when you get these pullbacks, we don't want to, just keep adding and adding and adding because that's not our risk management style. Certainly even in the sell-off of 2022, there were periods where we wanted to be overweight. We did go overweight and we got stopped out. That's part of our process. We do get stopped. That's okay. But we want to certainly, when we get to levels where we feel there is a fundamental reasoning, there's supportive technicals that build around that story. There is catalyst as to why the market should perform. We've got an expected range that we think the market will be in over an estimated holding period. Then we want to go to active risk. And so we're continuing to do that. As I said, we're really winding down any spread positions that we take. Spreads in our world being semi-government securities or supranational securities in some of the portfolios, making sure that we get really clean. I do think that into the end of the year that they can underperform a little bit, as they often do. We're just trying we're staying active, but clearly, we're waiting for that fundamental foundational data to continue to decay, more so than just being anemic to actually negative. And then that will really give us more conviction to go for duration.
Okay, great. And I guess off the back of that, Peter's asked, where will interest rates stop? You kind of alluded through your presentation, we've got the 5 scenario analysis, but, what is your kind of upside do you think we could touch and, or is it?
Look, the thing is that if we sell off, it tends to happen very quickly. And not to get too technical, but there's a thing called negative convexity where people need to re-hedge positions. So it tends to be a bit of a beach ball underwater moment. It pushes down quickly, then it pops back up. Exactly as we've just seen with push to 5% rates and back at 440, 450 something today. Can we go, beyond 5? Yeah, of course we can. There's absolutely no reason why we can't. It will start to take a lot of other things with it. It's, the tablecloth off the table. It's not going to just leave all of the cutlery sitting nicely, set up for the dinner party. I think everything will break. And at that point, you do get, oh my God, flight to quality move. I want to get back to the security of government cash flows. That's when that pro-cyclicality loss of confidence moment comes. Think back to the GFC, somebody goes down, who's next? It's death by association. People that are perfectly viable get put to the sword, which is not fair, but that's just human psychology. Can we sustainably stay at 5.5 or 6? No, I don't think we can. Can we get there? Sure. For a short period, why not? Conversely, can we swing back the other way? Of course. So answering that with precision is certainly hard given, after COVID, we've kind of picked up the economic jigsaw and just thrown it in the air. Pieces have landed everywhere. it's still all coming back together. The data volatility is not as extreme as it was, it's getting much easier to read, but it is still volatile. And so we're going through these mini cycles of, real contraction in the leading data, for instance, in developed markets was really, really bad at the start of the year. And then it's just moderated a bit. Now, that doesn't mean that the economy is vastly accelerating. It just means it's just not, particularly in the rate of change, it's not getting worse. It might be lower and then it just flattens out. Where that ultimately lands is a great question. Unfortunately, we don't have a crystal ball like, many investors, none of us do. But certainly, in the medium to long term, the valuations are very appealing.
Yep. Okay. And then we've got Glenn, who's picked up on, I think, marketing slate that's going around the market, which are bonds are back. And it's a common phrase we're hearing. But his question is fixed income the new crowded trade, or does it not kind of work that way?
Well, if it's a trade, it can get crowded. If it's an investment, no, because you just earn 5% and you're happy with that and, you run it off, right? So I think it's important to kind of think through, who's doing what. Unsurprisingly, bond allocations through real money investors the world over are very high right now. That's just simply a reflection of where yields are at. I kind of explain it to people that if you think about government, there were always natural investors that bought government bonds. They were the kind of bedrock to a building out a portfolio. Certainly, if you run institutional money or government money, pension money, oil money, all those kinds of investors have bought bonds for a long, long time. When bond yields go to zero, as they did under financial repression from central banks, those investors get forced into the credit markets to find yield. That dislocates the natural holders of credit, pushes them into high yield. High yield move over to alternatives. Alternatives go to equity, private equity, venture capital. The next thing you know, people are investing in jurisdictions they've never heard of, in technology they don't understand, and they're still making money in digital monkeys and crazy stuff. Fast forward to today, obviously the restoration of yield right back at the start is back to fives. It means the stuff at the end of the line goes unsponsored, because who wants to run the risk of that? And we've seen the way that that's performed. Certainly the listed vehicles there have done incredibly poorly. Some of the private stuff, hasn't maybe been marked yet, or there hasn't been the redemption flow to force it out. But certainly the flow of funds comes back into more traditional asset classes because there is real return. And as I said, with real yields being now, into the mid twos, that becomes very appealing. And certainly, you do get to a point where why would you buy that building out the back there when you have to just fix and maintain it the whole time, when you can buy government guaranteed cash flow with similar characteristics that is just a set and forget? So, you can see that there is appeal. Bonds are back. That doesn't mean that bonds can't go higher in yield. Of course they can, but certainly the motivations for wanting to come into the product, lifted materially. We always talk through the other elements to it with regard to that liquidity optionality that they provide, with the deep negative correlation that you get in real stress. Not in real stress, the correlation moves around a little bit, as we've seen. It's been positively correlated in 2022, and it's now digging in and changing again. That's not a static relationship. But yeah, bonds are back. It's a crowded trade. Yep. But as an investment, I think it makes perfect sense. And so crowd away, you're getting paid something by governments that, as I said, love or loathe them. They're there. They can always tax us, and it's a real return.
And then I think just digging into that, you mentioned a whole bunch of asset classes that got the bid when rates were suppressed. But which part of the fixed income space might you think is not attractive at this point in time? That was a follow-on question.
I'm obviously concerned about the repricing in credit, and obviously that starts from the lowest quality credit. So think to, rewind 3 or 4 years ago, I'm running a high growth technology company in the United States. I don't make any money, but I'm growing like stink. Can I borrow $250 million, please? Yeah, of course you can. There you go. We love this kind of stuff. That is not a fundamentally sound business. And now its cost of capital is not 4, it's 9, 10, 11, 12. Maybe it's not even there at all. Yeah. But I want my $250 million back, please. Well, we've already spent it. We don't have any money. So lend it to us again and we'll keep growing, and then we'll make money and we'll pay you back. That is not a sustainable state. So clearly that's the stuff that becomes problematic early on. There is, of course, some, maybe they get refied, maybe they don't, who knows. But that's where it starts, and that's where it becomes pro-cyclical. And so once those types of things start to fail, the markets get very concerned about what comes next. Who's next in line? The rumour mill, I mean, my God, I remember back to the GFC. I was in London at the time, walk into the pub after work, and it's just which investment bank is going to fail next after Lehman. And I worked at Merrill Lynch, which ended up failing to Bank of America. Bank of America tried to buy Merrill Lynch at $110 a share. I think they ended up paying $4 or $5. So the capital destruction is just extraordinary when it occurs. And of course, as the equity price falls, then you get downgraded by the credit rating agencies because there isn't the ability to raise equity capital like there was, and it becomes pro-cyclical. That is the business of banking. So, and obviously the wanton desire to provide liquidity and capital at that point, everybody pulls back, and we'll just focus on the loans we've already made. So that's an obvious one. I guess, in terms of asset allocation, unless you think the RBA and central banks the world over can continue to hike rates materially, floating rate exposures are probably run as far as they can. They're still really yieldy, so you don't need to leave by any means. But at some stage, you probably want to move to fixed because fixed will accelerate lower at some point. If not, they're already potentially higher than the floating rates. A lot of that floating rate exposure is in the corporate world. Again, Australian corporates are really high quality, so I'm not that worried about that per se, other than we know if US corporate credit spreads widen, we're not going to stand still. We do follow those markets. So in terms of performance, I think that's an obvious one where there could be some further performance. As I said, we don't ever ask for 100 cents in the dollar in the fixed income allocation, but there is a lot of reasoning as to why it's higher now than it has been. And certainly with corporate credit, you want to buy that after the hand grenade's gone off, not when the pin's pulled out. And so we're kind of in that dangerous period right now where there could be some adjustment that occur. It might not occur, of course, but it's possible. It's more possible.
Yeah, correct. Okay, and then the last question, because we are pushing up against time, is from David, and he asks: Are we on a surprise that the high debt levels and interest rates are so much so there hasn't been an impact on asset prices yet, and then equity, property, credit spreads, etc. And I guess that unknown, when do these interest rates actually bite and have these impacts that we're all kind of, I think, expected to come?
It's definitely a surprise to us, unquestionably, and I think to many that we haven't seen more of a slowdown to this point. We just keep hanging on. That's why I make reference to that 2007 period, in a world that's just getting faster and faster and faster and more immediate, and these cycles seem to get quicker. This one's actually just taking time, as it has done previously. I think, it's pretty obvious to see where that's headed. And unless we can get, corresponding wage gains, which we're not getting as a global series of employees to meet those elevated inflation levels, then our cost of living is slipping. And certainly here in Australia, there is just less discretionary spend. That simply must impact businesses. You go and talk to businesses, and they're still doing okay. They were doing better. They're not doing poorly, so that's a good news story. But they're not accelerated as they were coming out of COVID. And I think that the forward looks slower again. So I don't have that exact answer as to when it will bite. It's certainly coming up. I have been surprised, as many. We've had a lot of economics folks in here recently that really specialise in the timing of these things, and they're surprised also. But I think we're all uniform in that. It doesn't get easier from here. It's just about what rate do we decay at and when does that become self-fulfilling? Because it does start to chase itself lower. That's when we need policy support traditionally. And how much policy support do we receive at that moment? And that's why it's just so critical that we kill this inflation monster in total so that we can receive that policy support to bring things back into equilibrium. It's obviously, we got way over our skis coming out of COVID. It's required something absolutely extraordinary to break that momentum, which it broadly has, but the problem is we just haven't stopped and gone the other way yet. We don't want to go back all the other way because that's dire and it causes a whole series of issues. But I think central bankers are much more comfortable with dealing with crises than they are with dealing with things that are running way too hot. And so, in many respects, they've got much more of a playbook with that. I don't think they want to go there. But the danger is that they make a policy error, we overstep, and it will, need to be severely addressed.
Awesome. Okay, well, with that, we've come up just past the time, and I just wanted to say, on behalf of Charlie and myself, James, thank you for your time, Charlie, and thanks for everyone for listening. And we look forward to seeing you in the new year, and have a safe and happy holidays.
Thanks a lot, guys.